Welcome back to GeoScope, the channel where we map global power through trade, currencies, and strategy. Today we're tracking the dollar's decline, Trump's tariff gamble, and how allies from Australia to Germany are quietly reshaping the economic order. The air on Wall Street was thick with anxiety. Currency traders, already pushing the dollar lower for weeks, were looking for a sign of strength from Washington. Instead, they got Treasury Secretary Scott Bessent. The dollar was already sliding when he walked into Bloomberg's studio. By the time he walked out, it had fallen another 0.5%, a dramatic plunge in the world of foreign exchange. Markets didn't hear reassurance in his calm delivery. In fact, the calmness was the problem. In a high-stakes negotiation, a placating tone signals a weak hand, and traders heard retreat. The tell came with his subtle admission. Washington's August 12th tariff deadline was flexible. In diplomatic language, that means delay. In financial language, it means weakness. And in Beijing, where state media quickly amplified the remark, it meant opportunity. Bessent told investors not to panic, but the plea itself was the source of the panic. It's the oldest rule of markets. Real confidence is demonstrated, not declared. It doesn't need defending. This wasn't just a communications blunder. It was a revelation of strategic weakness. If Washington truly held the high ground and its economic leverage was overwhelming, it wouldn't be signaling concessions on live television. It would be silent, letting the pressure mount. Instead, it was blinking first. The truth behind this retreat is unavoidable. The administration's signature tariff policy is backfiring. The promise was a renaissance of American industry. The reality is a quiet recession in the very sector the policy was meant to save. U.S. manufacturers are cutting shifts, not adding them, as rising input costs and retaliatory tariffs choke off demand. In May, payrolls in the sector fell to their lowest level since 2017. Industrial output is now contracted for 4 consecutive quarters. The ISM index, a key barometer, dropped to 45.8, well below the 50 threshold that marks expansion, signaling a deep and accelerating decline. The cause is clear. Costs are surging due to self-inflicted policy. Aluminum prices for U.S. buyers are up a staggering 42% over global markets. Steel is 33% higher, copper nearly 28%. These aren't luxuries, they are the backbone of modern industry. And for what? The stated goal was to revitalize domestic production. Yet U.S. steel production has barely moved. Capacity sits at 74%, the same as before the tariffs. The policy has failed to incentivize new investment. The bulk of this protected aluminum isn't flowing into warships, it's ending up in beer cans, meaning every American pays a little more for a six-pack. This painful reality is why Bessent has been forced to shift his pitch. What was once framed as a national security fight is now marketed as a consumer victory. But the pivot is fragile, built on a misunderstanding of the modern supply chain. Over 60% of U.S. imports from China are not finished goods but intermediate products: electronics, semiconductors, and complex machinery. These are inputs the American economy cannot function without. Nowhere is this contradiction clearer than in the high-tech sector. Even as it wages a trade war, Washington has restored export licenses for NVIDIA to supply advanced AI chips to Chinese firms. The U.S. is simultaneously trying to contain China's rise while providing the very tools it needs to accelerate. It's a perfect illustration of an unwinnable conflict, where the two economies are so deeply intertwined that every punch thrown lands on oneself as well. Meanwhile, after a period of calm, inflation is creeping back. Tariffs are contributing to rising input costs. Core goods rose a stubborn 0.3% month over month. More telling, durable goods like cars and appliances are now rising faster than services for the first time since 2021, a symptom of economic distortion. This anxiety is reflected in the bond market. Treasury yields are climbing, not because of optimistic growth forecasts, but because of palpable risk. Investors are demanding a higher premium to hold U.S. debt. And beyond tariffs, a second front is opening, a plan to remake the Federal Reserve. Jerome Powell's term as Fed chair ends in 2026, and a potential new administration wants a more compliant central bank. The goal: install a leader willing to slash interest rates to fuel short-term growth and ease the burden of servicing America's massive national debt. Potential successors like Kevin Hassett or Christopher Waller are seen as far more dovish, prioritizing growth over inflation. Unlike Powell's inflation-fighting stance, their approach would mean aggressive rate cuts. The inevitable consequence would be a significantly weaker US dollar, eroding its global standing. The hard numbers from the Commerce Department confirm this. May's trade deficit didn't just widen, it exploded to $97.8 billion, a staggering 10% jump in a single month. Exports fell 6.1%, with industrial supplies and automotive parts declining, while imports held flat. The fundamental imbalance is accelerating, not improving. The US must borrow more from the world to pay for its consumption. China, meanwhile, isn't waiting. It has already pivoted, aggressively building an alternative economic bloc. Exports to fellow BRICS nations are up 11%, with finished electronics and machinery leading the way. Shipments to the Middle East, hungry for infrastructure, jumped 14%. This is a strategic effort to build a trade ecosystem that bypasses the dollar. Key US allies are adjusting. After years of frosty relations, Australia's Prime Minister Anthony Albanese arrived in Beijing with respect, not demands. He met Xi Jinping and formally reopened talks on their critical trade pact. The urgency is clear. China is Australia's top buyer, with $220 billion in bilateral trade. Double its volume with the US commodities like iron ore, LNG and wine, are national lifelines. But Beijing is also playing the long game, investing heavily in iron ore mines in Guinea. This diversification systematically reduces its dependence on Australia, ensuring Canberra's future leverage will only shrink. Other nations are caught in the crossfire. Indonesia struck a $19.5 billion investment package with Washington, but it wasn't enough to overcome new tariff walls, leaving its nickel exports uncompetitive. The result? Jakarta turned to more Chinese industrial imports to stay afloat. In Europe, Germany is charting its own path of de-risking, not decoupling. Chancellor Friedrich Merz has launched an independent trade mission to Southeast Asia, bypassing Washington. German exports to China grew nearly 7% last quarter, driven by an "in China for China" strategy. Giants like BASF and Siemens have expanded in Guangdong. Volkswagen, facing fierce local competition, pledged another €2 billion to its joint venture in Anhui to develop local EV models. And perhaps most significantly, India is shifting its tone. Long seen by Washington as the key democratic counterweight to China, New Delhi is playing a more nuanced game. While border tensions remain high, India's trade with China has surged to a record $136 billion. Prime Minister Narendra Modi has been a vocal champion of the BRICS bloc, calling for a multipolar world order. India is hedging its bets, pursuing its Make in India policy while deepening ties with both the West and the China-Russia axis. Middle powers are prioritizing their own national interests. But this isn't just a future hypothetical. For some, the shift is already underway. Brazil has taken a decisive step. In a landmark move, President Lula visited Beijing to sign a deal allowing bilateral trade to be settled directly in their own currencies, the yuan and the real, bypassing the US dollar. This isn't merely symbolic, it's a practical maneuver to reduce transaction costs and insulate their economies from the volatility of American monetary policy. This financial alignment simply reflects economic reality. Today, over 1/3 of all Brazilian exports from soybeans to iron ore are destined for China. That's more than its trade with the United States and the European Union combined. As trade routes are redrawn, the global financial system is adjusting in parallel. The signs are undeniable. The Bloomberg Dollar Index has seen a significant downturn. More tellingly, the world's appetite for US Treasuries, long considered the safest asset, is waning. Major holders are actively reducing their exposure. Saudi Arabia has cut its holdings by 27%, Japan by 11%. And in a historic shift, China is no longer the top foreign holder of US debt. This isn't a panicked capital flight, it's a calculated rotation. Central banks are diversifying, moving capital into traditional safe havens like gold, but also into Chinese sovereign bonds and a basket of BRICS-linked currencies. A new financial architecture is being built reflecting an emerging multipolar world.